In this session, I'm going to introduce what is CMA. Already you know, CMA means Credit Monitoring Arrangement. This is basically an Excel document. We also call it a CMA report. This document will enable the banker to understand the past of the borrower and what is the future that borrower is planning. Okay, so it is one document which will enable the banker to look back and also look forward. Look back in the sense the data from financial statements of the borrower for the past 3 years will get captured, and in case of new customers, yes, obviously only the future estimates will be there, but for the borrower who are already into business, who have been into business for more than 3 years, their past 3 years information will get captured. That information will enable the banker to understand in what direction this borrower was going. Okay, whether the sales are increasing or decreasing, whether profits or losses are there, what is the relationship between the sales and profit, what is the profit margin, how efficiently they are running their business, how they are managing their liquidity position, whether they could meet payments on time, whether they could meet loan obligations on time, what is the relationship between their assets and sales, what is their relationship between the assets and liabilities, whether they are fundamentally strong or whether they are highly leveraged. Like this, many information you get to know by looking at the statement called CMA, Credit Monitoring Arrangement. Okay, the basic documents that becomes part of the CMA are: number 1, operating statement. This is nothing but your statement of profit and loss reduced in a slightly different format to make it more understandable for the bankers. Then liability statement, which captures outside liabilities and owners' equities. Asset statement, split as current and non-current. Okay, so this 3 is nothing but your P&L and balance sheet. Okay, and this will give the overall picture in terms of the operational performance and financial position of the borrower. First, I'll show you operating statement. This operating statement will capture sales information, and again the sales is split as domestic sales, export sales, then less excise duty, GST as the case may be. Finally, you will have net sales. So this net sales will get absorbed by various expenses and eventually will be landing on the profit. And look at here, previous year 3, 2, 1. So past 3 years information will get captured, and estimate for the year they are working on, projection for the year after that. This 5 years information will generally get captured if it is a working capital proposal, and the period will go beyond if it is going to be a term loan proposal. Okay, so till here net sales information will get captured, and from where we are going to capture all this information? For the past 3 years, information will get captured from audited financials. Look at here, audited. In case the immediate previous year audited financials are not yet finalized, then bankers will be insisting on provisional financials at least. Okay, unaudited but provisional financials. And by looking at this statement, you will know what is their total sales. Sometimes the split up between the domestic sales and export sales may not be available, so banker will be insisting on the split up, or the borrower will be advised to furnish the split up as to how much is their domestic sales and how much is their export sales. And this becomes very critical and relevant, especially when the borrower is having export sales, because the credit facilities for export sales are assessed slightly different, in a different way, number one. Number two, it is also beneficial for the borrower because export credit facilities are cheaper when compared with domestic credit facilities. So what is their export turnover? That information should be clear. What is the trend in the export turnover? Only on that basis, banker will also be able to finalize what can be the eligible limit for this borrower. Okay, so that's about net sales, and this is only about past, right? How about the future? How can we estimate sales for the future? Is it possible? Yes, obviously, because when you look at the past 3 years information, you get to know in what direction the sales are moving. Because look at here, this sales captures what is the movement in sales, percentage rise or percentage fall. I mean, let me just put some numbers. Let's say this is 100, 120, 150. So what you can notice is previous year 3 to 2 sales has increased by 20%, and 2 to 1 it has increased to 25%. Okay, and estimated sales for, let's say, the current year, if it is something like 170, it's just 13% increase. So it may be possible because this company or this unit had a track record of registering 20% growth in sales, 25% growth in sales. So this 13% growth in sales shouldn't be a difficult matter. But if I'm going to say it's going to be 300, that is going to be 100% increase in sales, then that cannot be accepted just like that. It has to be substantiated with detailed reasons. How can sales double itself? Maybe some new capacities were added. It means some new project was added during the year. Probably there will be some term loan funding. Okay, in that case, it's not going to be a simple proposal. Or they were been operating at a lower capacity so far. Probably from this year only, they are achieving their optimum capacity. But again, you have to satisfy yourself whether this 100% jump is possible, whether orders are on hand, or what is the sales they have achieved so far. Okay, so what is the sales they have achieved so far? What are the orders on hand? What is their capacity level? Okay, all this will give you sufficient inputs either to accept or reject this level of sales. Okay, so you have to look at the trend in the past to accept or reject the estimated projected turnovers. Okay, so I just gave you some hypothetical numbers. Let's continue. Right, so that's about sales. And again, estimate will have detailed decisions. Okay, because estimates will have lot of validations. I mean, several aspects have to be confirmed, satisfied before bringing that sales figure over here. So what are those aspects and all we'll touch gradually. So I'm just introducing the CMA, and what we have seen so far is the sales element alone. And here this excise duty, now we can also say GST. Okay, if the sales figure is including that, then that GST portion element have to be deducted. Or when the sales figure is net of this GST, then no issue at all. Okay, right. So in that way you get to know what is the sales position, and what is more important is the trend, in what direction this is moving. Is it going up or coming down? If in the past the sales is coming down year after year. Let's say year 100, year 2 80, year 1, that is the latest year, is 75. Then what we can notice is this company is making a or recording a decrease in sales year after year. If you look at previous year to 20%, immediate previous year 6.25% fall in sales, and if all of a sudden they say that they will achieve 200 167% increase, then that need lots and lots of validation, because they were reporting drop in sales year after year. Now all of a sudden they are saying that their sales is going to double or more than double. Then how it is possible? It has to be seen, it has to be validated. Okay, right. So in this session I have just introduced CMA, explain what are the aspects that have to be looked into with regard to sale. We'll be talking more about this in the following sessions.
Cash credit, overdraft, letter of credit, bank guarantee, term loan. These are all the major credit products which banks gives for business entities. And how these credit products are assessed, there is a science behind that. And we have taught all those in our comprehensive online course called Credit and Financial Analysis Mastery. And you can get a demo version of it by just commenting DEMO, comment demo, and I will share the demo link of the comprehensive course so that you can go through the course and take a decision about the enrollment.